Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Let's go over some of the pros and cons in regard to these options. Some of the pros. Limited risk. The most you can possibly lose is the $3.25. Once again, I apologize for the typo that we had on that, but $3.25 is the maximum risk for that specific trade. Another advantage, flexibility. You can do a lot of different things with this. Income. Now, when I say income, you need to kind of take it as a grain of salt because you are at risk. When this is an income-based strategy, yes, it is, but it's not income-based in the similar format as to how a treasury bill would be. There's more risk involved with this. Another pro is that the volatility risk is less with this than it is with a single leg option. You're actually selling some premium to offset the premium that you buy. Time decay is less of a risk than with a single leg option also. Reason being is that you're selling some premium to offset some of the premium with which you are buying. So, with all that being said, these are things that can be benefits to doing a calendar spread. Now, of course, let's go over some of the cons that exist. You have the temptation to over leverage. If I can make this much money with $325, then I can make even more money with $3,250. Beware of that. Time decay risk is there. You still have that long option that is working against you. Implied volatility risk is also there. Each option has its own specific implied volatility. So with that, you need to understand that implied volatility could go against you in either option, theoretically. The other thing with a calendar spread, it requires active management. On top of that, this typically requires a good set of rules from the trader and or the advisor with which the trader is working. Once again, it needs to be emphasized that every individual investor will have their own goals and their own needs when doing this. Now, what if you still are a bit bullish? This is a dilemma that premium sellers must face, because with the calendar spread, remember, you're hoping that the calendar spread expires right at the money. You're saying that the time decay will be eaten away in the near-term option, and that time decay will expire faster than the time decay that's working against you in the long-term option. You're thinking it's going to stay around the exact same level. Right now, let's say that we are a little bit bullish. At-the-money options have the most extrinsic value. So with that, that makes premium selling quite the benefit in the calendar spread side of it. However, you're giving up all the upside. What we need to do is come up with a trade out to where we can still be a little bit bullish. In trading, it's all about trade outs. You can format the trade in whatever way you want, bullish, bearish, or neutral, but you need to, whenever you give something, you need to kind of expect something to be taken away from you, so to speak. So let's do a trade out. And the trade out is going to be the diagonal spread. What we're going to do within this is, sorry, I got my slides mixed up here. We're going to give up some of the premium. With that, we're going to actually get some upside potential. So in this case, instead of buying a long-term option at the money and selling a near-term option at the money, we're going to be selling an out-of-the-money option instead. So with that, the diagonal spread is born. Let's do an example. Now, with the diagonal spread, there are 4 possible diagonal spreads as we're going through the lingo of this today. Although you can use all of them, we believe that the diagonal call debit spread is the simplest to understand, so that's the route with which we're going to be going for today's presentation. Of the 4 diagonal spreads, we have the call debit. Call debit is what we'll be discussing. That's where you buy a long-term call option and sell a near-term call option at a higher strike price. That is typically a bullish neutral position. The call credit spread is where you buy a long-term call option, sell a near-term call option at a strike price below what you bought. We have the put debit, to where you buy a long-term put option, sell a near-term put option at a lower strike, and the put credit, to where you're buying a long-term put option and selling a near-term put option at a higher strike price. Let's go over our example. XYZ is trading at 80. Same concept as to what we had before. And I see I have the addition right on this one. Once again, I apologize for the typo on the last one. XYZ is trading at 80. You buy a 12-month 80 call for $5. You can sell a 2-month 85 call for $1. Now with this, your ultimate risk is $4. The dream price at the near-term expiration in 2 months is $85, and that's for the underlying. That's the highest the underlying can go without being assigned on the short call. The near-term call is sold for income, and the long-term call acts as a hedge and a partial long position. There will be deltas that are on that long-term call. As with all option trades, as with all long option trades, this is a defined risk trade. However, like the calendar spread, the overall reward will be unknown because there's room for anything to happen with volatility skews. So with that, typically the diagonal spreader is someone who has a little bit of a bullish sentiment but wants to sell premium in the near term to kind of hedge some of the time decay risk that exists. Now, the pros and cons of the diagonal spread. The pros: the potential profit on a long call and short premium. So with that, if the market does go up a little bit, but not a lot, you can let the short call expire worthless and the long call actually gains a little value to it. Premium risk that exists in option trading is taken away partially via the short call. Reason being, with the short call, you have time decay working in your favor, while the long call time decay is working against you. Overall, with this position, time decay is in your favor. However, it will work against you as time goes by. This is a very flexible strategy. You can roll in, you can roll out, you can do a lot of different things with this. Some of the cons that exist with this diagonal spread strategy. Less premium is taken in than the actual calendar spread. So with that, if the market does remain the exact same, then you will not take in as much premium for the near term. Volatility risk is there, and it's based on the long-term premium. From the standpoint that if volatility does decrease, then you've locked in that implied volatility for the 12 months or 10 months or however long you've actually used when doing this. Should the underlying decrease, the strategy may need to be altered into a credit spread, a calendar spread, or you can actually take a loss. Folks, there's no sin in just taking a loss. Sometimes it actually is better than making too many adjustments. Once again, be careful as you're going through this. Each trader or investor is totally different, and everyone has their own specific needs as they do this. Now, with that, let's talk about time decay considerations. Time decay is in your favor with either of these strategies. So with that being said, the reason is that the shorter term options decay faster than the longer term options. Now, one thing that I can tell you, and if I ever say the word guarantee, I will be put away in handcuffs, so I never say that word, but I can tell you the closest thing to that is that the sun's going to rise tomorrow. So I'm going to go out on a limb and actually say that. And if for some reason I'm wrong, well, you know what? The sun's not going to rise tomorrow anyway, so I'm willing to take that risk. That's the benefit of being an option seller, is that you have time on your side. Disadvantage is that you are giving up upside potential as an option seller.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.